Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Sir John Templeton. And right now, the market feels like a guy who drank 6 espresso shots, opened Robinhood at 2 a.m., and decided AI will solve literally everything. That's the mood. 7 companies are now carrying the weight of the entire American stock market, like exhausted gym bros trying to deadlift the economy. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla. The Magnificent Seven. Together, they now make up roughly 1/3 of the entire S&P 500. Think about that. 7 stocks out of 500. 1/3 of America's most important index. That's not diversification anymore. That's basically putting your retirement portfolio on a private jet with Elon Musk and hoping nobody touches turbulence. And if this feels familiar, good, because history has seen this movie before. The only difference is the soundtrack changed from disco music to AI hype podcasts.
Wall Street had its own version of the Magnificent Seven. They called them the Nifty 50. These were the untouchable stocks. They are Coca-Cola, IBM, Disney, McDonald's, Xerox, Polaroid. Investors believed these companies were so dominant, so perfect, that valuation no longer mattered. Sound familiar? People literally called them one-decision stocks, meaning you buy them once and never sell. This is basically the financial equivalent of saying your ex would never cheat on you. And we all know how that story usually ends. The Nifty 50 traded at insane valuations.
Polaroid hit 90 times earnings. McDonald's traded above 80 times earnings. Xerox traded at nearly 50 times earnings. Meanwhile, the broader market sat closer to 19 times earnings. Today, we're hearing the exact same language. This time is different. AI changes everything. These companies are money-printing machines. And to be fair, some of that is true. Nvidia's revenue explosion was real. Microsoft dominates enterprise AI. Meta became an advertising cash machine again. But history teaches something brutal. Great companies do not always equal great stocks, especially when you overpay. Even Coca-Cola, one of the greatest businesses ever created, dropped more than 60% during the Nifty 50 collapse. Not because Coke stopped selling soda, because investors paid fantasy prices. That's the key lesson people forget. Bubbles don't require bad companies. They require unrealistic expectations. Now, let's talk numbers, because this is where the story gets uncomfortable.
The Magnificent Seven now account for approximately 34% of the S&P 500's total value. Back in 2016, they were only around 12%. That concentration has nearly tripled in a decade. And in some weeks during 2026, these stocks accounted for nearly 85% of the S&P 500's gains, which means the market is starting to behave less like an economy and more like a group project where only one kid is doing all the work. Here's the second problem: valuations. Some analysts estimate the average PE ratio for the Magnificent Seven remains around the low 40s. That's extremely rich, especially while earnings growth is slowing. Nvidia's growth is still massive, but psychologically, investors feel disappointed. Tesla's automotive margins reportedly fell from around 32% in 2021 to roughly 18% recently. AWS growth slowed. iPhone sales plateaued. Cloud growth normalized. Meanwhile, AI infrastructure spending exploded. These companies are spending hundreds of billions building data centers because everyone is terrified of missing the AI gold rush. And here's where passive investing changes everything. Today, trillions of dollars automatically flow into index funds, meaning if Apple becomes bigger, index funds automatically buy more Apple. Not because it's cheap, not because it's undervalued, just because it's bigger.
That creates a feedback loop. Price rises, index weight rises. More passive inflows arrive. Price rises again. Beautiful on the way up. Terrifying on the way down. Because if investors panic, the same machine reverses, and forced selling becomes the villain. Exactly what happened in previous market manias. Now here's the twist nobody on financial TikTok wants to admit. This is not Pets.com. These businesses are monsters. Apple generates absurd cash flow. Microsoft owns enterprise software. Google controls internet search. Nvidia basically became the arms dealer of the AI war. These are elite companies. But elite companies can still become overcrowded trades. And in 2026, cracks are starting to appear. The broader S&P 500 has increasingly diverged from the mega-cap tech rally. Equal weight indexes have started outperforming at times. That matters, because it suggests investors are quietly rotating underneath the surface. And this is where the comparison to the Nifty 50 becomes dangerous. Not because the companies disappear, but because expectations eventually collide with math. That's the part retail investors hate.
Math doesn't care about narratives. At some point, even revolutionary companies need earnings growth big enough to justify trillion-dollar valuations. And if growth merely slows, not collapse, just slow, multiples compress. That's how investors lose money, while the company itself survives just fine. Coca-Cola survived, IBM survived, Disney survived. But many shareholders waited over a decade to break even after the Nifty 50 bubble burst. That's the scary part. You can be right about the company and still wrong about the stock price. So how does this sequel end? Nobody knows. Maybe AI truly becomes as transformative as electricity. Maybe Nvidia grows into every valuation thrown at it. Maybe the Magnificent Seven will continue dominating for another decade. That's possible.
But history whispers a warning every time markets become concentrated around a tiny group of can't-lose companies. The bigger the crowd, the harder the exit. And the smartest investors in history were never the loudest. They survived because they respected risk. They diversified. They stayed emotionally neutral while everyone else became euphoric. Because investing is not about proving you're right. It's about surviving long enough to compound. And in markets like this, independent thinking becomes more valuable than ever. Trees don't grow in the sky, but neither does fear. So stay curious, stay skeptical, and never confuse a great story with a guaranteed outcome. If you want to keep tracking the reality behind the narratives, make sure to subscribe and turn on notifications. We drop deep dives into market history and structural data every single week to help you think independently in a crowded market. Stay skeptical, stay smart, and I'll see you in the next video.